biggest mistakes I've made by far are mistakes of omission and not commission.
Warren Buffett. You only need to know these 7 rules. Warren Buffett is the greatest investor of all time. If you would put $1,000 into his investment company when it started, it would be worth over $30 million today. Such returns can seem unrealistic, but how did Buffett actually do it? The answer is he understands what most people don't, and is sticking to a few key principles that you can implement in your everyday life. Keep watching, because by the end of this video, you will learn all of them. Rule 1. Hire people with integrity, intelligence, and energy. Buffett emphasizes the importance of integrity in addition to intelligence and energy when hiring people. He says,
We look for 3 things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity.
Integrity is fundamental for success in any endeavor, as without it, intelligence and energy can be misdirected, causing more harm than good. This principle is essential not only in hiring, but also in personal growth and leadership development. Trust is the foundation of a company's prosperity, heavily reliant on the reliability and honesty of its employees. By prioritizing integrity in hiring, organizations build teams of capable and trustworthy individuals, fostering a culture where ethical conduct is standard. This creates a workplace where employees feel secure that their colleagues and leaders will consistently act with integrity, promoting a positive and supportive environment. A culture of integrity significantly reduces the likelihood of unethical behavior, safeguarding the company from potential scandals and legal issues while enhancing its reputation. Ethical companies attract and retain clients and partners who value integrity, further bolstering their success. Valuing integrity encourages employees to speak out against unethical practices, contributing to a transparent workplace culture. Personally, developing integrity involves aligning actions with values and maintaining honesty, which builds strong character and a trustworthy reputation. Individuals with integrity earn respect from peers and leaders, leading to better career opportunities and meaningful relationships. In leadership roles, integrity is indispensable, as leaders who embody integrity set a strong example for their teams, emphasizing ethical behavior as essential for success. Such leaders inspire trust and loyalty, crucial for team unity and long-term organizational achievements. Leaders with integrity make well-founded decisions based on a solid ethical framework, ensuring enduring success and positive impacts within the organization, creating an environment where ethical behavior is the norm and fostering a sense of stability and trust that is critical for long-term success. Rule 2. Understand investor behavior. Buffett has a deep understanding of how investor psychology impacts markets. He explains,
The answer is that investors behave in very human ways, which is they get very excited during bull markets.
Investors often look to the past rather than the future, which can lead to overly optimistic trends and market bubbles. This backward-looking perspective can cause investors to become overly confident during bull markets, thinking that past gains will continue indefinitely, leading to poor decisions like borrowing money to invest more heavily just because recent trends have been positive. Buffett's understanding of this tendency helps him profit from the mistakes of emotionally driven investors, as overly optimistic investors often drive prices to unsustainable levels, creating bubbles. Conversely, when pessimism sets in, prices can fall too far, creating opportunities to buy undervalued assets. By avoiding herd mentality, which is driven by fear and greed rather than careful analysis, Buffett makes rational decisions and takes advantage of market downturns to purchase undervalued assets. His disciplined approach reduces the risks associated with following the crowd and improves the chances of achieving long-term investment goals. Independent thinking is key to his strategy, allowing him to avoid market hype or doom and focus on investments likely to yield steady, long-term returns. Buffett's ability to stay calm during market downturns is particularly noteworthy, as he sees these moments as opportunities to buy quality assets at discounted prices. His confidence in his own analysis and understanding of market cycles enable him to make bold moves that pay off in the long run. Maintaining discipline is essential for long-term success in investing, and Buffett's strict adherence to his investment principles, regardless of market conditions, helps him weather short-term volatility and avoid impulsive decisions based on market sentiment. Rule 3. Seize opportunities created by market fluctuations. Market volatility can create significant opportunities for astute investors. Buffett notes,
Look in the rearview mirror and they say, I made money last year, I'm going to make more money this year.
Buffett's approach involves staying level-headed and focusing on the intrinsic value of investments, allowing him to make the most of market ups and downs without being swayed by them. Understanding an investment's intrinsic value is key because it helps investors spot when the market isn't pricing assets correctly. Armed with this knowledge, investors can make smart decisions about when to buy or sell, avoiding knee-jerk reactions to short-term market swings. Market fluctuations often provoke emotional responses, leading investors to make impulsive decisions based on fear or greed. By focusing on intrinsic value, investors can maintain a rational perspective and capitalize on market inefficiencies. Keeping discipline during market turbulence is crucial, requiring patience for the right investment opportunities and the determination to act boldly when market fears loom. Buffett's strategy emphasizes the importance of waiting for opportunities to buy high-quality assets at attractive prices, leading to significant long-term gains as the market corrects itself. When markets are volatile, many investors panic and sell off their assets at low prices. Buffett, however, sees these times as opportunities to buy, acting with boldness and confidence during market downturns to purchase undervalued assets that others are offloading in fear. This contrarian approach is a cornerstone of his investment success. Buffett's disciplined approach involves thorough research and a deep understanding of the companies he invests in. By focusing on businesses with strong fundamentals, he ensures that his investments are sound, even when the broader market is turbulent. This strategic decision-making helps mitigate risks and positions his portfolio for long-term success. Buffett's success through various market cycles demonstrates the effectiveness of his disciplined and logical investment approach. By consistently applying his principles, he navigates chaotic market times and emerges with strong returns. His long-term focus allows him to weather short-term volatility and avoid the pitfalls of trying to time the market. Rule 4. Buy wonderful businesses at fair prices. Buffett learned the principles of value investing from Ben Graham, focusing initially on buying stocks cheaply. He recalls,
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap.
However, Buffett realized that buying high-quality businesses at fair prices is more sustainable and profitable in the long run.
It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Buffett's transition from cigar butt investing to focusing on buying wonderful businesses at fair prices illustrates a profound shift in his investment strategy over time. Initially influenced by Ben Graham's emphasis on quantitative analysis and buying cheap stocks, Buffett sought out undervalued cigar butt companies that offered brief opportunities for profit. However, he soon recognized the limitations of this approach and its reliance on fleeting opportunities. Buffett's evolution towards investing in exceptional businesses at reasonable valuations stemmed from his realization that enduring success and profitability lie in owning high-quality companies. These businesses typically possess competitive advantages, effective management teams, and stable earnings that insulate them from market volatility. Patiently waiting for the right moment to purchase these stocks at fair prices is crucial, as it mitigates risks and enhances long-term returns. Buffett's adherence to this principle underscores its effectiveness, demonstrating that sustained investment success hinges on selecting and holding on to superior businesses rather than chasing momentarily attractive deals. Rule 5. Stay within your circle of competence. Understanding the business and its long-term economics is essential. Buffett emphasizes,
I have an old-fashioned belief that I should expect to make money in things that I understand.
he uses Wrigley chewing gum as an example.
I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now.
Buffett's principle of staying within his circle of competence underscores the importance of investing in businesses whose long-term economics he can confidently predict. He emphasizes the need to understand not just the product or service offered by a company, but also how its economic fundamentals will likely evolve over the next decade or two. For instance, he uses Wrigley chewing gum as an example, where he can reliably forecast the market dynamics despite technological advancements like the internet. This approach ensures that Buffett invests in industries and businesses he comprehensively understands, minimizing the risk of venturing into unfamiliar territories. For investors, this strategy promotes better evaluation and informed decision-making, fostering confidence in their investment choices. Moreover, Buffett's commitment to continuous learning through extensive reading exemplifies his adaptability to evolving market conditions, highlighting the importance of combining specialized knowledge with ongoing education for sustained investment success over the long term. This blend of expertise and learning agility remains a cornerstone of Buffett's investment philosophy, enabling him to navigate markets with foresight and prudence. Rule 6. Learn from mistakes of omission. Buffett acknowledges that his biggest mistakes have been missed opportunities within his understanding.
Biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission.
He shares an example.
20 years ago or close to it, when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft, because I don't know it. Microsoft isn't in my circle of competence.
Warren Buffett, well known for his smart investing skills, openly admits that his biggest mistakes were not making bad investments, but missing chances to invest in areas he understood well. He reflects on these missed opportunities as a key part of his investing philosophy. Buffett regrets times when he knew enough to make a good decision, but hesitated, which caused him to miss out on potentially big profits. For instance, he mentions not buying Fannie Mae when it was struggling financially, a move that could have been very profitable for Berkshire Hathaway. Buffett's willingness to talk about these missed chances shows how important it is to learn from mistakes in the complex world of investing. By looking closely at where he went wrong, Buffett shows how vital it is to always try to improve and make smarter decisions. Thinking back on these experiences doesn't just help refine how to invest, but also encourages a disciplined approach to taking advantage of opportunities that fit one's skills and goals. Buffett's strategy is about understanding that even great investors can stumble if they don't act on opportunities they know well. This thoughtful approach contrasts with the idea that investors should mainly focus on avoiding losses through cautious strategies. Instead, Buffett believes in a balanced view that includes taking risks in areas where you have expertise, seeing missed opportunities as harmful as making bad investments. Investors can learn valuable lessons from Buffett by deeply understanding their own strengths and weaknesses. By becoming experts in specific industries or investing methods, people can reduce risks when dealing with unfamiliar areas and better seize opportunities. Buffett's way of doing things stresses how crucial it is to match your actions with a clear understanding of the economic and long-term potential of investments. Rule 7. Seize big opportunities. Buffett stresses the importance of seizing significant opportunities when they arise.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it.
He advises a disciplined approach to decision-making.
You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch.
Warren Buffett's emphasis on seizing big opportunities underscores a fundamental principle in his investment strategy. He stresses that significant chances, whether in business or investing, should be grasped with conviction and acted upon decisively. Buffett's philosophy revolves around making informed decisions based on thorough research and careful consideration of risks and rewards. By advocating for a disciplined approach to decision-making, he suggests that each opportunity should be evaluated against long-term objectives, ensuring alignment with his investment principles. This mindset not only encourages boldness, but also promotes strategic thinking. where each major financial decision is treated as a precious resource to be used wisely. Buffett's success highlights the importance of being prepared to act when favorable opportunities arise, leveraging his deep understanding of businesses and markets to achieve sustainable growth and value creation over time. His approach serves as a guiding principle for investors looking to navigate uncertainties and capitalize on moments that can significantly impact their investment outcomes. Warren Buffett's investment success is a testament to his disciplined approach and adherence to key principles. By focusing on integrity, understanding investor behavior, capitalizing on market opportunities, buying quality businesses, staying within your circle of competence, learning from mistakes, and seizing big opportunities, you can emulate his strategies in your own life. Buffett's wisdom extends beyond investing. It offers a framework for making better decisions and achieving long-term success in any field. Embrace these 7 rules, and you'll be well on your way to making sound, profitable decisions that stand the test of time. For more insights and strategies inspired by Buffett's approach, please subscribe our channel for ongoing updates and guidance.